Welcome to the art of portfolio diversification, a strategy that balances risk and maximizes growth. Investing can feel like navigating a stormy sea. Markets rise, fall, and sometimes crash unexpectedly. But there's a way to sail smoother waters: diversification. Today, we'll explore how to build a portfolio that thrives in any market. We'll break it down into simple, actionable steps. Whether you're a beginner or a seasoned investor, this guide is for you. Let's start with the basics. What is portfolio diversification? It's the practice of spreading your investments across different assets. Think of it as not putting all your eggs in one basket. If one investment fails, others can cushion the blow. This reduces risk while keeping growth potential alive. Diversification isn't about eliminating risk entirely. It's about managing it smart. In 2025, markets are more unpredictable than ever. Inflation, interest rates, and geopolitical events create volatility. A diversified portfolio helps you weather these storms. Let's dive into why diversification matters. First, it lowers your exposure to any single asset. If you invest only in tech stocks, a sector crash could wipe you out. But mix in bonds, real estate, and commodities, and you're safer. Second, it smooths out returns over time. Some assets rise while others fall, balancing your portfolio. Third, it opens doors to new opportunities. Different assets thrive in different economic conditions. Diversification lets you capture growth wherever it happens. Now let's look at the core principles of diversification. The first principle is asset allocation. This means dividing your money across stocks, bonds, and more. A common split might be 60% stocks, 40% bonds, but it depends on your goals and risk tolerance. Younger investors might lean heavier on stocks for growth. Older investors might prefer bonds for stability. The second principle is variety within asset classes. Don't just buy one stock or one bond. Spread your stock investments across industries like tech, healthcare, and energy. For bonds, mix government, corporate, and municipal bonds. This reduces the impact of any single failure. The third principle is geographic diversification. Invest in both domestic and international markets. Emerging markets can offer high growth, but also higher risk. Developed markets like the US and Europe provide stability. Balancing these helps you tap global opportunities. Now, let's talk about the main asset classes. Stocks are shares in companies offering high growth potential. They're volatile but great for long-term wealth building. In 2024, US stocks returned about 10% on average, but they can drop sharply during recessions. Bonds are loans to governments or companies. They pay interest and are less volatile than stocks. In 2025, high-quality bonds yield around 4%. They're a safe haven when stocks tumble. Real estate includes property or real estate investment trusts. It offers income through rent and potential price appreciation. Real estate can hedge against inflation. Commodities like gold, oil, or agriculture are tangible assets. Gold, for example, often rises during economic uncertainty. In 2024, gold prices hit record high. Cash or cash equivalents like savings accounts are ultra-safe. They provide liquidity but low returns. Each asset class plays a unique role in your portfolio. Mixing them creates a balanced, resilient strategy. Now let's explore how to diversify within stocks. Growth stocks like tech giants aim for rapid expansion. They're exciting but volatile. Value stocks are undervalued companies with steady earnings. They're less risky and often pay dividends. A mix of both balances risk and reward. You should also diversify by company size. Large-cap companies are stable giants like Apple or Microsoft. Mid-cap companies offer growth with moderate risk. Small-cap companies can soar but are unpredictable. Spread your investments across all three. Sector diversification is equally important. Don't overload on one industry like tech or energy. Invest in healthcare, financials, consumer goods, and more. This protects you from sector-specific downturns. For example, tech stocks crashed in 2022, but energy soared. A diversified portfolio would have balanced those swings. Let's move on to bonds and how to diversify them. Bonds vary by issuer, maturity, and credit quality. Government bonds, like US Treasuries, are the safest. Corporate bonds offer higher yields but more risk. Municipal bonds fund local projects, and are often tax-free. Mix short-term and long-term bonds. Short-term bonds are less sensitive to interest rate changes. Long-term bonds offer higher yields but more volatility. In 2025, interest rates are expected to stabilize. This makes bonds a solid diversification tool. Real estate diversification can be simple. You don't need to buy property direct. Real estate investment trusts trade like stocks. They own commercial properties, apartments or malls. Diversify across property types and regions. Urban retail might struggle, but industrial warehouses thrive. Commodities add another layer of protection. Gold shines during inflation or market panic. Oil ties to energy demand and geopolitical events. Agriculture can hedge against food price spikes. Invest through commodity funds for easier access. Now, let's address alternative investments. These include private equity, hedge funds, and cryptocurrencies. Private equity invests in non-public companies. It's high risk but can deliver outsized returns. Hedge funds use complex strategies to beat the market. They're less correlated with stocks and bonds. Cryptocurrencies like Bitcoin are speculative. They surged in 2024 but crashed hard in 2022. Use alternatives sparingly, maybe 5 to 10%. They add diversity but come with higher risks. How do you decide your portfolio's mix? It starts with your risk tolerance. Can you stomach a 20% drop in your portfolio? If not, lean toward bonds and cash. If you're comfortable with volatility, stocks might dominate. Your time horizon matters too. Saving for retirement in 30 years? Go aggressive. Need funds in 5 years? Stay conservative. Financial goals shape your strategy. Are you aiming for wealth, income, or preservation? Growth seekers might favor stocks and real estate. Income seekers might prioritize bonds and dividends. Preservation seekers stick to cash and safe bonds. Let's look at a sample portfolio. Imagine a moderate investor, age 40, saving for retirement. They might allocate 60% to stocks, 30% to bonds, and 10% to alternatives. Within stocks, they'd split across US and international. Half in large caps, a quarter in mid caps, a quarter in small caps. They'd cover tech, healthcare, and consumer sectors. For bonds, they'd mix treasuries and corporate bonds. Alternatives might include a real estate fund and gold. This setup balances growth and safety. But portfolios aren't set and forget. You need to rebalance regularly. Markets shift, and so does your asset mix. If stocks surge, they might dominate your portfolio. That increases risk beyond your comfort zone. Rebalancing means selling winners and buying laggards. Check your portfolio at least once a year, or after major market moves. This keeps your risk levels steady. Tools like robo-advisors can help. They automatically build and rebalance diversified portfolios. Many charge low fees, making them accessible. But always review their recommendations. Your goals and preferences should guide the process. Let's talk about common diversification mistakes. One is over-diversification. Owning too many assets can dilute returns. Studies suggest 20 to 30 stocks are enough. Beyond that, you're just adding complexity. Another mistake is ignoring correlation. Assets that move together don't diversify risk. For example, tech stocks often rise and fall as a group. Choose assets with low or negative correlation. Stocks and bonds often move in opposite directions. That's why they're a classic diversification pair. A third mistake is neglecting to monitor. Markets evolve, and so should your portfolio. What worked in 2020 might not work in 2025. Stay informed about economic trends. Adjust your strategy as needed. Let's discuss current trends shaping diversification. In 2025, inflation remains a concern. Assets like real estate and commodities can protect you. Interest rates are stabilizing, but still impact bonds. Short-term bonds are safer in this environment. Technology continues to drive stock market growth, but don't overinvest in one sector. Emerging markets are rebounding. Countries like India and Brazil offer growth potential. Include them for diversification, but limit exposure. Sustainable investing is also gaining traction. Green energy and ESG funds attract billions. They align with values and can diversify your portfolio. How do you start diversifying today? First, assess your current investments. Are you too heavy in one asset or sector? List your stocks, bonds, and other holdings. Second, define your risk tolerance and goals. Be honest about what you can handle. Third, research diversified funds. Index funds and ETF are great starting points. They track broad markets at low costs. A total stock market fund covers thousands of companies. Fourth, consider dollar cost averaging. Invest fixed amounts regularly to smooth out volatility. Finally, consult a financial advisor if needed. They can tailor a plan to your situation. Diversification isn't a one-size-fits-all. It's personal, reflecting your unique needs. Let's recap the benefits of diversification. It reduces risk by spreading your investments. It smooths returns through market ups and downs. It positions you to capture growth globally. And it gives you peace of mind. You're not betting everything on one outcome. In a world of uncertainty, that's powerful. Before we wrap up, a few final tips. Start small if you're new to investing. Use low-cost funds to keep fees down. Stay disciplined even when markets panic, and keep learning about new opportunities. Diversification is your shield and sword. It protects you and helps you grow. Thank you for joining this journey. Start building your diversified portfolio today. Your financial future depends on it.